Hello and welcome to our webinar on selling in a shifting market. I want to thank you for trusting the Mark Boyland team and joining us today to discuss a topic that I've received a lot of calls on. We did have some technical difficulties on the original webinar concerning the recording, so this is a re-recording of that webinar, and we've also made some updates because, as you can probably guess, things keep changing on a daily basis. So I'd like to start off by saying I appreciate and respect what everyone's been going through the last couple of weeks. I could certainly tell you that for our business, it has been a wild ride. And, you know, as many of you might know, the real estate brokerages were deemed non-essential about 2 weeks ago. So we could not do showings, traditional in-person open houses, or have listing or buyer consultations in person with clients. Effectively, we were shut down. So since that moment, it's been all hands on deck for our team, and we've been working around the clock on ways to help our clients continue to move their transactions forward in a safe manner. And then on Wednesday night, the state reversed their decision and made us essential. So we now can operate in a limited and safe capacity, and I'll get into how we're doing that a little bit later. For those that may not know me, my name is Mark Boyland. I'm a realtor with Keller Williams Realty. I've been in the business for over 25 years, and I have an absolutely amazing team of 18 people that work with me and tirelessly support our clients, and I'm proud to be in business with them every day. Last year, we helped more clients buy or sell real estate than any other team or agent in our 7,000 member multiple listing service. And I'm also on the board of managers for the One Key MLS, which is the 5th largest multiple listing service in the country. And I'm able to see what's happening more on a regional basis from that experience. Also, this is not my first rodeo when it comes to shifting markets. I started my business in a shifting market in 1995, went through the most recent housing crisis in 2008, and in 2009, in addition to selling real estate, I traveled around the U.S. and trained about 1,500 agents on how to help their clients in that changing market. And from that experience and from that mindset standpoint, I feel prepared to deal with what we're going through right now in the industry and in real estate, and we'll discuss that as well. Now, I do want to make sure and be very clear that from a real estate perspective, this shift is not like 2008. The housing market is in much better shape than it was last time. It's more prepared than it was in 2008, and we're going to get into why this is the case. Now, on the original webinar, we had some guests. We had Alan Lichtenstein, who is a real estate attorney with over 40 years experience, answering some questions as to what's going on from a legal perspective in real estate, and Peter Kulka, who is a senior loan officer with Greenway Mortgage. Because this is a re-recording, they won't be joining us for this webinar today, but I'm going to highlight some of the points that they went through originally. So let's get into what we're going to talk about. First, we're going to go through the market shift, then and now. What's different between 2008 and now? And are we going to see a major market shift? What are we doing to adapt and innovate in order to help our clients in this market? And what are the potential opportunities for sellers and even buyers in this market? And we can go through some of the questions and answers that came up at our original webinar. So let's get started as to what's going on here before, pre-virus and current. So for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury rate. So what you can see from the last number of years is there's been a steady decline in interest rates, and that's been tied to the 10-year Treasury rate. Most noticeably, those rates have become very competitive recently. So when we take a look at what the Deputy Chief Economist from First American has said, he said, as evidenced by recent events, often the spread increases because mortgage refinance application processing capacity cannot meet demand. So lender offered rates don't follow the Treasury yield down 1 for 1. So while the mortgage rate has declined in response to the decline in yield, it is unlikely to fall by the same magnitude as the Treasury yield. It is plausible, though, that the mortgage rates fall further if the benchmark 10-year Treasury bonds yield decline further. It's reasonable to expect that rates will fall even further and likely surpass the prior record low, but not necessarily 1 for 1 with the 10-year Treasury yield. So that's important to note. You know, as those rates go down, obviously homeowners call in for refinancing, buyers start to pick up the pace and locking in rates. However, the lenders can't quite keep up with the demand and the processing. So they're not dropping those rates all the way down. You know, they're kind of what's called throttling, where they keep the rates a bit higher than they could go, because they can't even handle the demand they have. So why drop the rate lower, you know, and get more volume when they can't handle what they have? So that's generally why there's quite a little bit of a spread there. A lot of people have also asked me, well, didn't they drop the rates to zero? And that's really the Fed funds rate. So that 0% drop is not tied to mortgages. That's a kind of different animal. Mortgage rates are tied to the 10-year Treasury yield. And so mortgage rates will not go to zero. Well, who knows? Everything's kind of changing. But take a look at this, which I find fascinating. If you look back to March 5th, rates hit an all-time low of 3.29% on March 5th. That's incredible. That's absolutely incredible. Now, you notice that they've bounced back a bit too, right? Because the amount of traffic going to these lenders was so huge, they actually, you know, essentially raised rates to slow things down because they couldn't handle the volume that they had. But that is pretty incredible. And keep in mind, when you go back to even, what was it, March of 2019, 4.41. So basically, rates had dropped 1%. So think of it this way: for every 1% drop in interest rate, it actually increases a buyer's purchasing power by 10%. And of course, rates going up 1% would decrease a buyer's purchasing power by 10%, just to keep the same mortgage payment. So that's very powerful indeed. So how has the housing market been impacted by previous stock market crashes? Well, let's take a look at this historical perspective to see how that could translate into the current market. So when we look at the period from 2007 to 2009, the S&P 500 corrected by 51% over that time. But here's the thing: a lot of people look at the stock market and say, oh, the stock market's tied to the housing market. That is not the case. So when we take a look at here, it proves 50% drop in the S&P 500. Annual home price depreciation during that same period was less than 20%. So 07 had a 4.6 decline, 2008 had a 10% decline, 2009 had a 4.1% decline. So as you can see, there's not, you know, a one-for-one ratio when it comes to the stock market correction and home price depreciation. But let's take a look at some other events during the dot-com recession and the 9/11 crash. Okay, so we take a look at this. The S&P corrected 45%, down 45%. However, interestingly enough, annual home price appreciation. We had annual home price appreciation. It went up 8.6 in 2000. It went up 6.6% in 2001 and 8.5% in 2002. So here's a situation where you saw these market crashes, right, from these two big events, yet the value of homes went up. So not necessarily tied to what's happening in the markets. Let's look at some major pandemics and epidemic events, and this is released by the National Association of Realtors. When we take a look at annual existing home sales, in 2001 with 9/11, actually home sales went up. During SARS, home sales went up. During H1N1, they went up a little bit, they dropped a bit, and then leveled off. So it was only about a 3.5% home sales decline in 2009 and 2010. Median sale price in the lower chart, same thing. Your median sale price went up for 9/11, for SARS, and was fairly flat for H1N1. But keep in mind, that was coming out of, or the beginning of, the housing crisis of 2008. So that probably played more of a role in that than the actual H1N1 flu. So the point I'm trying to get across here is that recession does not equal housing crisis. And that's really important for you to understand. So when we look at what Bill McBride is saying from Calculated Risk, with the sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, my view is that the U.S. economy is now in a recession, which started in March 2020, and GDP will decline sharply in the second quarter, as Goldman Sachs is forecasting. The length of the recession will depend on the course of the pandemic. So here's the interesting thing. The length of this recession is going to be tied to the length of the pandemic. So the sooner we get out of the pandemic, the sooner we hit that tipping point and the virus stops spreading or at least starts to drop significantly, then the GDP will start to increase after that. So when we look at what Goldman Sachs is forecasting, they are looking at a -5% GDP in the second quarter. However, let's take a look at quarter 3 and quarter 4. It's going to be increasing, at least their prediction is 3% in the third quarter and 4% in the fourth quarter, with strong gains in early 2021. So this may be, and hopefully is a blip in the economy. Now, we take a look at what Wells Fargo is saying. We do not expect a repeat of the severe recession of 08 and 09 because the virus and oil shocks are not endemic to the financial system, but are rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and especially into 2021. So generally speaking, most financial experts are not looking at a long-term economic recession from this. Now let's take a look at the last 5 recessions: 80, 81, 91, 2000, and 2008. Really interesting. 3 out of the last 5 recessions had home price appreciation go up. 1980, it went up 6.1%, 81, 3.5%, and then 2001, 6.6%. 1991 and 2008 had decreases. 2008, much bigger decrease. Keep in mind though, 91 and 2008 were housing-driven recessions. So it certainly makes sense that home price appreciation or depreciation happened in those years, where the other years, those were not housing-driven recessions, and prices actually went up. So will we see a rise in the number of foreclosures? I'm getting this question a lot, or even short sales for that matter. And this is the interesting, the Federal Housing Administration indicated it is enacting an immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days. And the Federal Housing Finance Agency announced that it's directing Fannie Mae and Freddie Mac to suspend foreclosures and evictions for at least 60 days. And in New York, they're now pushing for a 90-day moratorium on that, in which case it will not affect people's credit, and they can push those payments off to a future date. Now, there is some talk about, after this is over, the banks are going to be requiring people to make up those payments right away in that 3rd or 4th month. Personally, I think they're going to be working with homeowners to do some sort of repayment plan on that. I can't imagine them expecting all of that money all of at once. And keep in mind, if you can make your mortgage payment, make your mortgage payment. This is not a free ride. This is not an event where you just stop paying because you want to take advantage of that. Please keep making your payments because they will be due at some point. But keep in mind, I've done when the market shifted in 08, I went out and learned everything I could about helping people go through the foreclosure process and helping them do short sales in order to avoid foreclosures. And my team and I, we've done well over 150 short sales successfully for our clients. And I can tell you that the banks and the government are much more prepared if we do see that. You can see from this ruling with the 60-day moratorium, they're getting ahead of it this time. They're going to work with people. They do not want a repeat of 2008. So if we do see some of that, the systems are in place. 2008 is really still fresh in their mind, and they can handle this much better than the last time. So I don't really, after doing that many short sales and working with dozens of banks through the 2008 through probably 2012, we were doing a ton of them. We're still doing some short sales, but I can tell you the systems in place for handling those are much better than they've ever been. But here's the other reason that I think we're still in pretty good shape. Total home equity cashed out by refinance in the billions. If you look at 2005 through 2007, America had pulled about $824 billion with a B out of their homes. Now, they use these home equity lines to do all sorts of things. A lot of those things probably weren't the smartest use of the money. You know, they were putting on additions, renovations for their home. They were buying pools. They were paying for college. They were using it for travel. They were buying luxury items. You know, not the great use of that money. And obviously, some people were using it for good reasons as well. But compare that to 2017 through 2019. And we see there's only $232 billion cashed out of people's homes. So right now, what that means is that America has more equity in its homes than it did during the last bust. And that's important to note. That means there's cushion there. So people have equity. They have cushion. They can ride this out if they need to. When the market shifted in 2008, there was no equity. There was nothing. If the prices went down by 2 or 3%, they were underwater. So they really had nothing to do but unfortunately stop making their payments if they had to sell. Now, the other thing that's really good is that payment as a percentage of income, the historic norm has been just over 21%. When we go back even a year and a half ago, the percentage of payment as income for housing was 18.2%. And you can see by this chart that those numbers kept dropping and dropping and dropping. And as recent as January of this year, it's 14.8%. So 14.8% of people's income is being put towards housing. Once again, a lot more cushion than the historic norm, much more. So that also means people are in a much better shape. Now, when we take a look at the number of showings in New York, this is where buyers and their agents are requesting showings to look at property. When we look at the first 2 to 2.5 months of this year, you can see by the orange line on the top, that's 2020, and 2019 is the darker line below that. And we can see that we were getting anywhere from 5 to 10, maybe even 15% more activity on our properties, on listings, than this period last year. So what that tells me is that there was going to be a fairly robust, active selling season because there's more buyers out there looking. So now obviously those showings have dropped substantially because of what's going on. That makes sense. Everybody wants to be safe. However, that means there's going to be pent-up demand. So as this virus kind of secedes and we kind of get back to normal in the future, there are going to be a lot of buyers out there that were in the queue that needed to buy, wanted to buy, that will be coming back into the market. So we were on pretty good track there. So what are we doing to adapt and innovate in order to help our clients in this market? Well, a number of things. We've really had to completely shift how we're doing business, and we want to make it safe for our clients, obviously, for our sellers and our buyers. So here's what we're doing. One, we're doing virtual buyer consultations. So we're using video conferencing software to do a full consult for buyers and for sellers. We're doing e-signature documents where we can send all the documents for e-signature, and our clients can sign those. We're doing 3 tours of our listings and requesting virtual tours from other agents' listings for our buyer clients, and virtual showings by our buyer specialists. So we can actually have one of our team members go into a listing and show the property on their cell phone to their buyer who's at home or waiting in the car or whatever it may be. We're implementing client care safety protocol kits. So we've actually have kits where we have gloves and booties, and we will have face masks for those that need them, agents that do want to do that virtual showing. And we have no contact showings. So as I mentioned, we're having these situations where our agents can go in the home with their phone and walk around with a video and show them what's going on in the house without them going out. And we're also doing our open houses from your couches program, which has really been working out extremely well, and we'll get into that in a bit. We also working with inspectors who offer no contact home inspections and YouTube video walkthroughs. And we're still adapting, and we're still trying to figure out new things on how to market properties in this market. But if you're thinking that the market is dead right now, nothing could be further from the truth. When we look at the market for the last 7 days in our multiple listing service, we've seen 429 new listings. We've seen 440 properties put under contract in the last 7 days. So these are deals that got put together after the virus, all the news, the shutdown happened. 173 homes have had a price improvement on them, and 323 have closed. So things are still happening in the market. So when we look at our own team and successes in the last 2 weeks, in addition to implementing all these new protocols and doing all this different type of marketing, we were able to put 6 accepted offers in the past 2 weeks. We have 2 deals under contract, and we've held 18 virtual open houses. And the virtual open houses is where we actually schedule open houses. We post them in all the major real estate websites, and there's a link there. The person clicks on it at that time, and there's an agent from our team that's walking them through the house on our 3D tours, answering questions, and giving them all the information that they need on the home. And we've had 2 properties, 2 listings that we put deals together where the buyer never actually entered the property. They looked at our 3D tours, we negotiated, obviously by phone and email, and we were able to put the deals together without the buyer actually entering the property on our own listing. So it's really been quite interesting. So with the 3D tours, which is great, we purchased a 3D camera, so all of our listings now have 3D tours. This means that the buyer can walk through the house as if they were in the home. They can look left, they can look right, they can look up and down. It really gives them a true sense of the property, and then we have 360-degree views for the outside. So they can really get the sense of the home before they decide to make a decision on it. The great thing about this is they can move from level to level. What you're seeing here on the screen is called a dollhouse view. This is where they can zoom out of the house and really see how the house is laid out as if it was a dollhouse that they were holding in their hands. And then they can zoom in and walk around in each room. You can also, which is also amazing, with our program, you can actually, the buyers can measure rooms. They can use a digital measuring tape and go through the rooms and measure the space as well. So it's been pretty cool. We also purchased a website called northofthecity.com, and we're now focusing on target marketing the city to remind city dwellers of the opportunities that we have out here in Westchester and Putnam and Fairfield County, because we have backyards, we have more elbow room, and just a lot more space. You don't have to get in an elevator with anybody. You don't have to walk down a hall with other people. So we have a lot of opportunities in Westchester for those city dwellers that might be thinking, you know what, now might be the time to move up to Westchester. So we're having people do that on northofthecity.com. And we have our client care safety protocol kit. So if we do have a situation where ultimately an agent or a buyer does have to enter the home after a deal is put together, we're providing with booties, gloves, masks that they can use and throw away after they're done. So what's happening in the mortgage industry? What innovations are happening there? So when we talked to Pete Kulka from Greenway Mortgage, they put a lot of money into technology-based platforms. They're doing secure communication from anywhere. They're doing e-signature documents. They're doing electronic messaging regarding your loan status. And obviously, they're on text and phone as well. So keep in mind, the mortgage companies are still operating a little bit differently, obviously, but they're still operating in this market. And when we look at closings and what real estate attorneys are doing, they're also doing, so Alan Lichtenstein is also doing e-signature documents. He's doing mail-away closings. He can do remote notary for powers of attorney, and he can use a wire instead of getting bank checks for money transfer. So, and when necessary, they're doing multiple closing rooms to separate people. So they actually have people in different rooms in the office, and they're keeping only the necessary parties at the closing. So real estate agents aren't there, loan officers aren't there. It's just the attorney and the clients in different rooms going back and forth. And sometimes they're using outdoors to sign documents or a separate room as well. But the state has allowed visual or virtual notary signatures at this point. So they're getting around that as well. So what are the potential opportunities in the market? Well, for one, interest rates are still historically low, allowing buyers to afford more home or to purchase in areas they were previously shut out of. Remember what I said before, a drop in interest rate of about 1% translates into 10% more purchasing power for a buyer, meaning that they can get 10% more house for the same monthly mortgage payment. So that's pretty incredible. So if you were shut out of a market or a certain type of home maybe a year ago, now you could actually afford that property. So we also have the lowest spring market inventory ever. This means less competition if you're a seller. So that might be a good time to be on the market because you don't have all those houses coming on the market you normally would this time. And we've seen some sellers pull their houses off the market because they don't think it's a good market, which is not necessarily the case, as we evidenced before with all the contracts are being signed and all the listings coming on the market. So there are people out there that are putting deals together. We have buyers that do want to buy, that need to buy. They were already in process before this all happened a few weeks ago. So they need to buy. They want to get that low interest rate. They don't have a lot to choose from. So we're starting to see better pricing on our listings because of that. Also, we have kind of a unique situation where the rest of the country might not have. We have residents from New York City who are looking for additional housing options in the suburbs. Now, right now, we're getting a lot of calls for short-term rentals because they want to get out of the city. They want 2, 3, 4 months rentals. Of course, a lot of landlords aren't willing to do a short-term rental because it doesn't make a lot of sense for them to go through that process multiple times. So while those short-term rentals are eating up some of the rental inventory, it's actually pushing prices up in the rental market for long-term renters who need a 12 or 24-month rental. So we're starting to see multiple offers on rentals, going over asking on rentals. And as that rental market dries up, there's going to be some home buyers or some people trying to get out of the city and move up here temporarily to say, you know what, it actually might just be less expensive for us to buy a home and then just move up here. So we may see this kind of knee-jerk reaction to purchasing homes because the rental inventory is just so tight and expensive that people start diverting into home purchasing. So bottom line is having your house on the market now, you're ahead of the game if there's a tipping point, if we see this tipping point, or there's buyers out there that are trying to take advantage of the rates, trying to take advantage of getting into a home right now, then if you have your house on the market now, you're ready for that tipping point when it comes, as opposed to rushing on the market after everything's okay again and competing with a whole bunch of inventory that's hitting the market at that point. So just something to think about. And of course, we don't know what the future holds, but generally speaking, we do see, demand picking up once this starts to die down quite a bit. So questions and answers. So, we got a lot of questions in regards to people in rentals. Are they going to get kicked out? And mortgage questions, paying their mortgage. Right now for both renters and for homeowners, there's a 2-month moratorium, actually in New York, 3-month, 90 days moratorium on evictions for people living in properties that they're renting, and also for mortgages. So, right now you're in okay shape. You're not going to be evicted if you've lost your job, you can't afford your rent, you can't afford your mortgage payment. Once again, if you can pay them, you should, because those numbers are going to add up. But you don't have to worry about being kicked out right now. So if you do have any other questions for me, questions for an attorney, questions for Greenway Lending, you can email me at mark@markboyland.com, or give me a call at 914-234-4444, and we can discuss with you specifics to your local market, your school district, your post office, your price point. Obviously, the market is different for every single area and every single price point. So we can actually put together statistics and information and graphs and pull, sales for you in those areas to give you a much more refined picture of what's happening in your local market, and talk to you about how to prepare for that. So I really appreciate you getting on the webinar today. I really appreciate what everybody's going through. I really appreciate the support that we've gotten through this process. I hope we can help you. I hope you can stay safe, and I look forward to seeing you in person, face-to-face, in the near future. Thank you, and take care.